Hey everybody, this is Kevin with Leading Edge Financial Planning, and today we're going to talk about the Delta Market-Based Cash Balance Pension Plan, the MBCBP, which I'll just call the Cash Balance Pension. So anyway, we put together this presentation. This is from publicly available information from Delta, but this is our opinion only. Please check all information for accuracy and how your situation is different or similar to some of the things I will discuss, and this does not constitute any recommendations or financial advice. So, with that out of the way, I am a CPA, a tax CPA, as well as a certified financial planning professional with Leading Edge. We work with airline pilots. We really enjoy it. And the contracts that were just passed were extremely exciting for us because there's more ways to save. So, here's the agenda. Why did Delta and other airlines create these plans? WIFM, which is used to be radio stations, so it was What's in It for Me, WIIFM, What's in it for me. So what's in it for you as a Delta pilot? What could go wrong? So anytime you have the saving, investing of money in any way, shape, or form, there's always something that could go wrong. We'll discuss that. If nothing else, there's the opportunity cost lost to do something else with the money. So that's something that we will discuss. Anyway, some strategies I put here, strategies that might be less obvious, maybe, maybe not. For those of you that are truly passionate about understanding all these programs, maybe you've already thought about everything I'm going to present, but if you haven't, I think that's a wonderful opportunity to learn about some ideas and thoughts that have come from us, as well as some of the Delta pilots that we've worked with over the years. I'm going to be very positive because, in general, we like any place that you can save money, defer taxes, strategize, and figure out what's the best thing to do for you and your family. So we do have a positive bias towards these types of programs, but we know there's also a lot of negatives with any programs. Nothing is perfect. The 401k, if you could invest in equities and they could always go up, well, that would be the perfect plan. It does not exist. Finally, time in the market. Yes, that age old, boring. It's not timing the market, it's time in the market. We definitely use tired phrases because they just seem to work. So let me tell you a little bit about the assumptions that we have here. Our first assumption is that we assume that we want you to save more. We assume that you want to save more, but that might not always be the case. We are fee-only financial planners, fiduciaries. We try to always do what's in the best interest of our pilot clients and families, but we still have biases and we still like certain things and dislike certain things that might not be exactly the same as yours. Please feel free to point out where you differ. We very much like when we have a respectful dialogue about anything that's presented on the on social media or the webs. So anyway, we will use past returns because everybody does. You probably do too. One of the big concerns about the cash balance pension plan is it's 40% equity and 60% bonds. Well, the reason why you might be upset with that is because we use past returns. We all do that. But no one knows with certainty what the optimal strategy is going to be going forward. But we will focus on decisions under uncertainty, and pilots may argue that we do not know blank. We take what we like from the unions, from pilots that we talk to, actual clients, which includes emotion and things that sometimes we're not thinking about. And we also try to look at this as an economist would, just trying to maximize the best way for people to retire and spend money. But anyway, that's our mission. There's always a better way. That's an assumption. This is not optimal for you. It's not optimal for anyone. There is nothing optimal in finance until 2020 in the rear. What was the optimal strategy? But decisions under uncertainty, we're going to use the past to make some educated guesses. And I put here, is it really as simple as fear and greed? And what I mean by that is that sometimes people say it's as simple as fear and greed, and sometimes it really does seem like it is. So, anyway, why did Delta and other airlines create these plans? The simple reason is that pilots are making, I'm going to call it too much money. I know you don't feel that way, but pilots make more money than can go into the 401k plan. And the huge reason for this is because the non-elective contribution is you making money, and that is going into the plan. And so therefore, you're very quickly, if you're, a first year or second year FO, obviously not, but if you have some seniority, you're almost always going to maximize your 401k. And so it used to be a little bit more difficult. We used to always talk about backdoor Roths coming next, and then we would talk about brokerage accounts. For some pilots that still don't have these cash balance pension plans, we talk all the time about brokerage accounts as being a retirement account. Um, but anyway, to put extra dollars somewhere, it's really nice to have some extra vehicles to put dollars in different places. Also, again, the strategy aspect of this is that you can wake up on January 1st every year and you could say, what's my strategy for this year? And you can do a mix of tax deferred. The money that's not elective is going to be tax deferred. You can choose to put non-Roth 401k monies in, and then you can choose to have money go into the market-based cash balance plan, which is tax deferred. And then you can also choose Roth because you can choose not only Roth 401k, but after tax contributions. So that's to me what makes this so exciting. I'm a super nerd, but that's what makes it so exciting for Charlie, myself, and the rest of the team. Um, when I speak to, especially when I speak to prospective clients, they always say their number one issue is they're paying too much tax. And so I put number one, number two, number three, location, location, location. This is the number one, question we get from pilots is there any way I can pay less tax? Now, really what we're thinking about here is tax avoidance, which means to avoid tax, never pay it. And when you work for the man, when you work a 9 to 5, however you want to put it, when you work for a company, it's very challenging when the money comes to you for it not to be taxed. You can't even do the per diems anymore or unreimbursed expenses, except in a few states. But it's very, very difficult to save taxes when you work for the man. So we're going to talk about delivering some tax deferral, which also could be tax avoidance if you're going to make less money or live in different states in the future. So when arriving at retirement, this is one of our favorite slides here. When you're arriving at retirement, if you look at the begin with the end in mind, what you really might want to have is you want to have some deferred wealth, okay? You did not pay tax in the past. You built up this big account of deferred wealth, 401ks, 403bs, IRAs, and yes, now market-based cash balance pension plans would be in here. The key is to fly below the radar of high tax brackets. There's a thing called the tax bomb, and tax bomb always gets everyone's attention. A bomb. Well, I want to know what that is, but really, there's a couple of different ways you can get hit with major taxes. And one of the big ones that we see for many pilot clients is that when they do have to take the required minimum distributions, they have such a big focus on the tax deferred money that then they're going to have to take out lots of money age 74, 75 going forward. And it's going to be more and more, and it creates some real high taxes. Now, the interesting part is that the market-based cash balance plan does not seem to benefit with tax deferred. But I'd like to discuss, a strategy about, trying to get as much money into Roth as you can with the levers that you have and allowing that market-based and the non-elective contribution to be your deferred money. So anyway, Roth accounts, Roth account, everybody loves a Roth. I don't have to go into that. Never pay tax again. I'll just say this, the biggest confusion I've seen recently is people have taken money out of their Roth IRAs and they have to pay some taxes and they're shocked. But if you don't wait till you're 59 and a half, have 5 years of Roth and a few other rules, you can pay tax on Roth IRAs if you're not retired. Taxable accounts, again, capital gains and income tax friendly vehicles inside a taxable account, they were the place that we would focus on before some of these market-based cash balance plans added another layer to complexity. So what's in it for you? The biggest number one reason why financial planners love this is we love automatic savings. The 401k, the idea of just doing things automatically, it really, even with ourselves as planners, we all set our money up on automatic because it's just so easy to save and invest. It's very hard to do it if you wait till the end of the year. The ability to save, invest, and then move money. Yeah, you can move money. You know this, 59 and a half. You can take in-service distributions. And you can kind of time when is the best time for a tax situation. When do you want to make these moves? And I put here that you may, I'm saying it's you. I may or may not have the opportunity to opt out or in to the market-based cash balance plan in the future when new contracts pass. At least that's the rumor. That you may, if you've used it for a number of years and you don't like it, maybe your situation will change as you get older, but at least you might have the opportunity to come in back and forth. Annuity options. What is an annuity? Well, annuity is just a series of equal payments. It's funny, not so much in aviation, but most people say they want a pension, but annuities allows you to set up your own ability to get money every year. Again, I know the pensions in the past have caused a lot of problems, some of them going bankrupt. So anyway, but you do have a series of equal payments for the rest of your life. That's part of the market-based cash balance plan. And to me, that's good to have. Most people will not take it. A solution for every pilot that is making high income and would like some way to pay less tax. Again, I said before that the number one, the number two, and the number three is about paying less tax, but the market-based cash balance plan allows you to defer and hopefully avoid some tax in the future. So mental accounting helps with the market-based cash balance plan. I'll get to that in a second. But if we think about risk first, I know the last number of years in markets, it's been really exciting to see the stock market just go crazy. But mental accounting can help if you know that this is your safe money. This is really your safe money. So a couple of times years ago when I started in this business, I got calls from clients when they were doing Roth conversions or Roth monies and there was tax. And I knew this from before from my training about being a tax CPA is defer, 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 always defer, pay money in the future. But that's not really true. And some of these people that were calling me were saying, hey, my CPA just told me that you're an idiot for doing conversions. And so I would call and talk to the CPA and they were like, look, my client gets upset when they owe tax in this given year. And I said, well, the whole situation is this, and it's really great that they're going to pay tax in a different year. But again, defer, defer, defer is something that a lot of tax people learn. It's not always true, but it's not a bad start with defer though. Okay, so if you're living now in California, New York, Illinois, New Jersey, and you think you're going to move to a more tax-friendly state in the future. I live in Tennessee now, which is one of the faves when it comes to income tax. Defer now when you're living in those tax unfriendly states, and then you can take money in the future as taxable income. You won't have to pay the state income tax, which is, getting pretty high in many states. Also, when you're in your biggest earning years, we'll have to see what happens with taxes going forward. But if you're in the 32, the 35, the 37, might even go back to the 39.6, and you also have an income tax from your state, boy, it's not a bad idea to defer in those years and try to put together a multi-year plan. This is the key, a multi-year plan to see if you can use lower brackets in the future, friendlier states, and pay with inflated dollars. Pay tax with future dollars that are worth less. Paying tax to get money into Roths is better than paying tax, putting it into T-bills. And I'm just going to touch on this quickly, but what the old idea was is that you defer as much as you could in your 401k. You fill it up. Again, pilots would get all of the NEC money and they would defer all of the money. It would create a big, big IRA 401k when they retired. Then they would get extra money and they would put it into the bank. And so they're deferring when they're in 35, 37% tax bracket. But then when they take that money that's in the bank and invest it in CDs and other really safe investments, they pay another 35 or 37% tax there. We think that one of the best strategies you can do is to try to pay tax on those first dollars in a way so you can get a lot of money into deferral buckets through the non-elective contribution as well as the market-based cash balance plan. So by paying taxes and get money into Roth, by putting after-tax money and making a right away a movement into the Roth 401k, you're paying tax and all that money's going to the best place, Roth. So anyway, it's at least a strategy we think everyone should consider. Owning bond-like investments in tax deferred, I was going to put always is better than owning them in a taxable account. The idea of the CD gets treated very poorly. And then I put almost always. Okay, so if you're going to own bonds, own them in a tax deferral account like the market-based cash balance plan. Absolutely, that is the best place to own them most of the time. Okay, so let's continue on. So this is the idea of having a client that gets paid and pays 35% tax plus 9% California tax, and then takes the money that comes to them after they had filled up their 401k, takes the money and says, I can do better than that market-based cash balance plan. So they take the 54% down here, I make it 55, but then they put that into a CD. When we look from right to left, right is the most tax favorable strategies, and the left is the least tax favorable strategy, which is interest income. Money market, corporate bonds, U.S. Treasuries, they all get taxed as ordinary income. Ordinary income. So they get their, let's say it's 55% into their bank account. They invested in T-bills and CDs. You'd be surprised how many clients that we've worked with over the years that have a lot of money in the bank. Money makes you feel good. So then they get a 5% interest payment over the year, but they only get to keep 2.75 because not only did the money that came to them from the airline get taxed, but then the interest also gets taxed as ordinary income. So, and I said, I just shrug. Yeah, I mean, that's the tax system. So a dividend capital gains, these are more favorable if you own stocks in a brokerage account and you don't sell for long periods of time. You can really control the nature of capital gains. Not always dividends. You can't control dividends. Tax exempt interest through muni bonds is it's kind of a boring investment, and sometimes they're good, sometimes they're not good. Pension and IRA, this is the deferral. And then we have some real estate, oil, gas, and tax exempt bonds as being over here. If you're into real estate, we as a firm work with a lot of pilots that also do real estate. It does have some tax preference. Again, it can't really lower your money from the airline, except in some really unique situations. And then the Roth and insurance are on the right, which is the most favorable place. Again, getting money into the Roth at the beginning of the year really seems to me to be a great strategy for most. Insurance, we're not a big fan of insurance. We think it's oversold, but yes, if you have insurance and you die, no one pays tax on it. So it's really quite tax favorable. That's another example of don't let the tax tail wag the dog. You got to die. So let's talk a little bit about what could go wrong. So money is in the market-based cash balance plan. So I'll just start with the most talked about one is that you get low returns and I put in great years with the stock market with high bond amounts, 60% bonds. Everyone knows this already. Um, yeah, and I'm going to show over a long period of time what are somewhat the expected returns, but that could go wrong. You cannot lose a dollar over the years. So this is a fantastic part to the market-based cash balance plan. If your value is lower than the money put in, you can't lose it. Delta will make you whole. And so, that's the other thing we hear sometimes from people is they say, I don't want to lose any money. Market-based cash balance plan can, but the thing that can go wrong here is the opportunity cost. And that's what everybody is thinking about, that I can't lose money, but I also could have made more money. No return whatsoever. That's really dramatic. If bonds and stocks don't do well at all, then that would be really dramatic, and there'd probably be a lot of bigger problems. And 401k wouldn't do well either. So, if Delta and the union allowed more equities, the plan could go bankrupt. So, this is what not this, but some pensions went bankrupt in the past because they just were not managed properly. And this pension is I would say less risky for the companies because you really do have a balance of money that they have, and that money is yours, and it can be taken with you. But if they had 100% equities in the market-based cash balance plan, not that they would, but then the plan could get into some trouble if stocks crash. Delta would be on the hook, for example, if you put in 100,000 and the market went down 50%, and then you retire. That could be bad. Maybe not bankrupt, but a bad situation. Of course, the worst is always if the U.S. economy goes really bad, flying stops, and stocks and bonds lose boatloads of money. That is always the worst situation. Risk is ever present in life. Anything we do in life involves some risk, even staying at home, sleeping on the couch. Strategies. Okay, so here's some of the ideas that we came up with as a team. The youngest pilots can do some mental accounting. So mental accounting is when you say, I got money here, it's worth this. I got money here, it's worth this. As planners, we don't usually want people to do that. We usually say, look, we want to manage your whole financial life, including the pensions that you have for military, the Social Security. We want to manage all of these things. But this is a case where mental accounting is if I'm a younger FO, or I just have a lot of time to go and I'm an FO and this money is going into a 40/60, I just need to think to myself that this is my safer money. So I don't need to put money in the bank account. You still do, but I don't need to have safer money anywhere else in my financial life. So if you're investing in a brokerage account, you might go more aggressive with equities, 401k, et cetera, et cetera. But you can just know that this is your safer money. I didn't say safe, I said safer. So the age 58 to 65 can do some income tax smoothing. And what I mean by that is if you're 58 years old right now, and you know you're going to have 7 more years and you're going to be at your max earning potential, you can have money, you can put a lot of money into market-based cash balance plan. You can put a lot of money into Roth. You can put a lot of money, into the tax deferral in the 401k, as much as you can. And then you can make some strategy about what your income is going to be year after year from 65 to 75. Now, Social Security comes in here, Medicare, Medicare surtaxes. It's called IRMA. Do you have to pay extra for Medicare if your income goes up too high? But there are some strategies here that you can do to have income tax smoothing. Again, I call it flying below the radar. Optionality to keep in the plan and then load up on stocks in your 401k. So what I mean by that is that, just in this case, don't use mental accounting. Look at your market-based cash balance plan as a 40/60 portfolio and just manage around it. A 50 8 to 65-year-old person who's 100% stock. That would scare me. Maybe some people would do it, but I wouldn't recommend it. So anyway, and then we also, again, hear from some people that are older and they know they're only going to fly for a certain amount of years. I don't want to lose this money. I don't want to lose money. Well, this is your bulletproof bucket two. We call it bucket two account, which safer assets. Again, you could still lose some money. However, Delta, if you really lost money over the life of the market-based cash balance plan, they would true you up. But this is really helpful. So pilots do not want pension for a good reason, but there are some optionality to annuitize. I should have read my slide before I presented it here. You do have the option of always annuitizing it. So again, there's some goodness in choice. There are some really specific reasons why pilots might consider annuitizing, and really the biggest one is those that are way behind and just don't have enough money to safely retire and use the 4% rule. They want to spend more money. So anyway, you do have the option to do that. And then I put here, you can kind of decide your strategy each year by turning up and turning down what you do in your 401k. And we'll get to the strategies there. But when I looked at the plan initially, I said, wow, you're in or you're out. That's it. Got no choice. But you really can maneuver each year and decide what you want to do when you are in. So the final one is tax defer. Eventually move it, maybe 59 and a half, maybe when you're done, increase the allocation when you're 59 and a half, and or get an income annuity to help support your retirement income. So this was put together by your union, and we think it's terrific. And so anything we say about this is our opinion, and ALPA has no responsibility for our comments, but this was one of the things we read. We really liked it. We've built calculators before. We're going to build one for Delta pilots as well. But pilot one is the FO, making 225. Pilot two is the captain, making 425. And I know these numbers are high, low, depending on where you are in your career. What year you are. But anyway, pilot one decides, I don't want to put any money in the 401k whatsoever. I'll just take what the non-elective contribution is. And so they put zero in, they get 38,250 from the company. All 38,250 goes into the 401k, no market-based cash balance plan. Okay, so pilot two is also an FO, exactly the same situation, but pilot two says, yeah, I want to get some money into the 401k. Now, this could either be Roth 401k, pay tax now, or if you're married and you're making 225, I hope you would consider to do Roth in your 401k. But anyway, company contribution, exactly the same. So all three of these, the non-elective is always going to be the same. So here, the 401k hits 61,250. It's a little bit below the max, but still, this pilot is getting a goodly amount of money in there. So pilot three in the 225 decides, just like the other two, that I'm going to try to have my strategy. My strategy is I want to get as much money as possible. I want to get as much money as possible into this sucker. We're living, we just got out of the military, we moved in with mom and dad, whatever the case is, we got plenty of money to save. And so they dump in the 23,000 for the 401k contribution, and then they start dumping in after tax money. It goes over to the Roth, and they fill up a bucket or the pilot contribution. They fill it up on April 30th. So they really, they don't stop the company from still putting in their 38,000, but they got to get that money in fast so that the 38,000 doesn't beat them to the punch and the limits. And then in this case, they have $94,500. I mean, think about this for a second. If you save $100,000 for 20 years, that's $2 million of saving. And this market-based cash balance plan allows you to do it. Again, all of this 56,000 could all be in Roth. You would have to pay tax on it, but you're not so worried if you're putting it all in Roth. You're not so worried about building a brokerage account because you have so much money that will never be taxed again. All right, so now we'll go over to the captain. Okay, so the first captain decides, I'm not going to put money in anyway. Non-elective contribution, boom, 72,250. Okay, 17 times 425, and that's what you get. And so, by the way, these are 2024. It will go up $5,000 for 2025, the amount that can go into the 401k. Total retirement contribution is just the 72,000. We've seen pilots through the years that have only done non-elective contributions, and they're okay to retire. And we've seen some that not okay to retire, just depending on how much they spend. So in this case, 58,650 goes to the 401k, and then it starts spilling into the market-based cash balance plan because 345 was the max until it had to go into the cash balance pension plan. So captain number one would probably be okay if a little bit of money went in there and they could go a little heavier invested in the 401k. Okay, so pilot number two decides I'm putting in the 23,000. I'm under 50. I'm putting in the 23,500, I think is what it is for 2025. The company does the same thing, which again is outstanding, $72,000. Who thought? Anyway, I never thought people would be getting that much money in their 401ks and other plans. Well, in this case, again, the market-based cash balance plan, you get some spill from the company with the non-elective, and it's going into the market-based cash balance plan, almost $100,000 saved. You put in 23, almost $100,000 saved. That's fantastic. The pilot number three is really determined to get as much money as possible into these suckers, and this is the goodness of this plan. So 53,948. You can do part of it as non-deductible, your 401k contribution. You can do all of the others has to be after tax. You got to rush it in. You got to get it in by March 15th. And then the company does its thing, and now you have $126,000 per year going into this. And what I said before is that you can't opt in or opt out of the market-based cash balance plan, but you can be pilot number one on certain years, and you can be pilot number three on certain years. Financial planners, if you ask us, we always want you to be pilot number three, but that's not always real. So a few things about the investment in the portfolio. Why invest in such a conservative portfolio? Well, there is more places like the market-based cash balance plan to save taxes in the short run, but you got to follow the rules. And we want Delta's market-based cash balance plan to be okay for all because this is, like we talked about before, this is your money. Lessons from past pension failures. I don't really know why the failures happen. I don't know at all why, but I just assume that the way that it was being invested, the amount of money coming in and the amount of money going out just didn't work. It doesn't mean that someone did something wrong. But in good times, you have the stocks 40%. Maybe you wish it was more. Bad times, you have cash bond. There's probably a little gold in there as well. But you have both good times and bad times. That's why the conservative portfolio is good. So let's talk about how good or how bad. All right, so time in the market. Yep, we're using this tired phrase. The reason why I put this slide in is when I looked back at when most of you were putting money into the market-based cash balance plan, it's very new, the returns of the potential Delta pension was a total of 1.17%. Not great. So we know from past history that it's not just about what markets have done in the past. It's what have they done for me? What's been the return for me? And we saw a few pilots, they shared their documentation with us that they were below the amount put in even. in some cases, just when the money came in. So anyway, the S&P 500 in this time period from uh, uh, July 15th, 24 to 12/31/2024 did 5.4%. That's three times more. But this is the lost decade. Okay, so lost decade now, 2000 to 2009. It was so long ago, it doesn't matter. The other lost decade was in the 70s. The other lost decade was the Great Depression. It doesn't matter. Well, if you were working in the lost decade, it would have mattered, and it might matter again if we have another lost decade. I'm not saying we will or may, but in this case, again, using the 40/60 portfolio as a proxy, 6.33% doesn't sound great, but then when you look at what the S&P did over those 10 years, it was negative. So again, having some diversification sometimes can be a very good thing. It's almost always is, but with the S&P last few years, it's hard to get excited about a 40/60 portfolio, and I get that. So, but what if the next decade? What if 2025 to 2035, the S&P 500 has another lost decade? It'll be the fourth time in American history if it does happen. And then 2025, yay! Tell the truth. Tell the truth. This year, when you knew you had the market-based cash balance plan, did it feel good to have that? I mean, yeah, I mean the S&P was down, just from peak to trough, it was down 19%, just short of a bear market. But at some point in time this year, I'm sure everybody was thinking, boy, I kind of like that market-based cash balance plan. And that's what diversification can do for you. Sometimes you kind of like it. Feels good. So this is the last slide. What are the gotchas or the rules of thumb? So we looked at the plan and we said, again, what are the things that if you're doing it, stop. So if you find out you're receiving a check from the market-based cash balance plan, stop for a second. Somebody tells you, oh, we're going to have to send you a check. Why? If you wanted a check, if you wanted the money, you wanted to pay tax on it, that's fine. If you wanted to move the money to an IRA and you have to get the check made out, just make sure it's like Fidelity, if it's an IRA for the benefit of, I don't even think Fidelity, you'd have to do that. But if it's Schwab or somewhere else, the check should say Schwab for the benefit of, and then your name should go there. That's the only time you want to receive a check. If the check's made out to you, just know you're paying tax on it. So next gotcha is if you have an ex-spouse. Proceed with care. I've worked with a lot of divorced people, and sometimes there's some stuff that's a little bit weird in divorce decrees. So just make sure that when you move money, if that will set you up for having to have another conversation with that person. And then finally, the other gotcha is if you go into a new year without a plan of your total savings goals, I think to me that's something with more wealth comes more responsibility. And again, you have the ability to use these different strategies and at least having a plan for each year on what you might want to do, because you're kind of locked in. If you want to maximize, you're kind of locked in if you don't get it in early in the year. So anyway, again, my name is Kevin Gormley, Leading Edge. Happy to chat with you. If there's anything I missed, if I got something wrong, if I misspoke about anything, please let us know. We love comments. We love any feedback that you have. Our mission is just to help educate pilots. Obviously, we work with pilots. That's how we get paid. But our primary mission is to educate pilots and help the entire group of pilots that fly. So thank you so much. Take care.
Leading Edge Financial Planning, LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Leading Edge Financial Planning and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for decisions based on such information, and it should not be relied on as such.